Welcome back, everybody. Everywhere you go online, there are people wanting to tell you how to invest and what real investing actually looks like. But in my experience, there are 4 common investing myths that actually have quite a bit wrong with them. So in this video, I'm going to pour myself a drink. We're going to sit here and talk about investing. And this might be something that I do maybe on Fridays just because it's a little bit more fun and breaks up the monotony. Now, I have a bottle of 1942 Don Julio right here. It's the last of a bottle that my wife got me last year on Father's Day, which is almost a full year that this lasted me, which is partially because I don't really drink as much as I used to anymore, and partially because I've been busy, and partially because I forgot about it and it was in the back of the cabinet. So I'm going to pour myself this. It's delicious, by the way, if you haven't had it. Yes, it's a little pricey, but I like it. And we'll get started. See if I can do this without spilling here. Whoa. All right. It's a little more than I planned, but, we'll go with it. And I know Father's Day is this weekend, so hopefully all you dads out there are going to get a chance to really enjoy it with your families like I'm planning. So to that, I say cheers, and let's get started. Okay, so the first one we're going to talk about, time in the market is better than timing the market. Now, in general, I actually agree with this one, but the reasons I agree are probably different than most people think. Now, the idea behind time in the market is greater than timing the market is, be a long-term investor. Don't have a short-term mindset. Don't panic when your stocks go down. Just keep holding, keep investing, and over time, it's going to go up. So again, in general, I agree with that. And if you've watched this channel before, you probably know why I agree with that. And it's because the money supply keeps going up. And we've talked about this before, right? The money supply keeps going up, which means that asset prices are going to keep going up. And that's why there's a big difference between people who actually invest and people who don't in terms of being able to build wealth. And so it's basically that as long as politicians are going to keep printing money and the money supply keeps increasing, then the people who have assets are going to do better than the people who don't. So just by that logic, if you're continuously investing, especially if you're investing like in index funds, then it makes perfect sense to say, look, the longer you're in the market, the better you're going to do. And I think that's generally true. Now, where I have a problem with this saying is when you start talking about individual companies and individual stocks. Because in that case, I don't think you can just say, oh, the stock market keeps going up, so just keep holding. Because individual companies are a little bit different. They're going to have things happening within the company that are going to be unique to them. They're going to have things that are unique to their industry. They're going to have things that are going to be unique to the environment that they happen to play in. And those are things that you can't really just ignore in terms of deciding whether or not to hold. Because the difference is that when you invest in an index, you're just investing in all the companies, and the index by nature is going to reward the better companies and give them a higher weight over time, so that every quote-unquote losing company has less impact on the index overall over a period of time. Whereas with an individual company, that's not true. If you keep holding an individual company that is doing terribly, that may never come back, it's going to continue to be a drag on your portfolio because it may slowly lose impact over time as it loses value, but it's likely going to have a much bigger impact on your portfolio than it would in a broader index. This is one of those sayings I think people overuse just because it's easy, right? The stock that you bought went down 30%, and you're like, it's okay. Time in the market's greater than timing the market. And then it goes down another 20%, and you're like, it's okay. Time in the market's better than timing the market. But none of those things that you've talked about have anything to do with the actual business, right? So remember, when we're investing in individual stocks, you're investing in an individual business that may or may not be doing well. And so regardless of what happens with a stock, just because it dropped 30% doesn't mean that it's time to sell, but it might, depending on what's going on with the actual company. Because for every company that came back from a 30% drop or a 10% drop or a 50% drop, there's companies that didn't. I mean, did Xerox come back? Did Kodak come back? Now, I know those are extreme examples and, 20 years old, 30 years old, but the same ideas apply. So while in general, I agree that time in the market is better than timing the market, especially if you're invested in broad market indexes, for individual companies, it's not quite that easy. And I think we just need to be cognizant of the fact that, look, when you're investing in individual companies, you're taking on the responsibility to say, I'm actually going to monitor and see how it's doing so I have an informed idea of how the business is performing. Because even in my own portfolio, I had Lulu, I had MSCI that dropped over 10%, 15% after earnings, but yet I held those companies because I believe in their business. Whereas Starbucks dropped about the same amount, amount, and I didn't believe in their plan, so I dropped it. So I'm not saying that those are right or wrong or that my perspective was the right one. What I'm saying is I treated each company differently because each company is different. So only time will tell on any of those three, but the reality is that just because you say time in the market beats timing the market doesn't necessarily hold true when you're talking about individual stocks. I felt like I took a long time on that one. I don't know. I guess I'll see when I get into editing. But more importantly, this is still full, so I have work to do. Okay, so the next one is, it's really a combination of two, but you'll get the idea. It's don't invest now, the market's about to go down, or hurry up and invest, the market is about to go up. And it doesn't have to be the market, it could be an individual stock or whatever. You guys have heard this, right? This is the idea that people kind of know what's going to happen next because they heard it on the radio, they heard it on a YouTube show, they heard it on a podcast. What's a YouTube show? YouTube channel, YouTube video? I don't know. I'm making up stuff now. And so this one seems kind of silly, right? Like, okay, well, of course we know that nobody knows for sure. But I think what you find is that when people are inexperienced at this or they're just starting out, they really let those words kind of weigh heavily on them because they just assume that whoever is telling them that is more experienced. Or even if we just take what we just experienced in 2022 and 2023, the prevailing wisdom was that the market was going to be in a tank, we're going to be in the recession and all this type of stuff. And in 2023, the market soared, right? So nobody really knows. And I think in the past, I think I did a video with Paul Tudor Jones when he was talking about, US stocks are done, it's Bitcoin and gold and all that. And I'm pretty sure that was like October of last year, which, pretty much the market has been up only since then. So, you can't really base anything on what people's opinions are of what's going to happen in the market. And that's something that we talk about a lot on this channel, where it was one of the findings for my own portfolio that I had in 2023, because I was so focused on macro stuff that I made decisions with stocks that I normally wouldn't have bought. And then I kind of regretted it later. And I ended up changing all that. And I know you guys know all that. But, the thing is, we can never predict what's going to happen. And a lot of what I try to focus on in my videos is, let's look at this individual company, right? It's much easier to say, okay, how is this company going to perform in 2024? So let's take McDonald's, for example. And we talked about this in a previous video. McDonald's outlook for 2024 is probably not very good, right? Rates are higher. It's a company that's kind of like a pseudo real estate company in terms of how their business model is. And they carry a lot of debt. So clearly, companies that carry a lot of debt in 2024 with rates kind of being higher than they've been over the last 10 to 15 years, they're likely going to trade down. Starbucks is experiencing the same thing. See, I can't even say experiencing anymore. It's clearly starting to work. And so if I was just looking at 2024, I may say, this isn't the right time to add McDonald's to my portfolio. But in my case, I already had McDonald's in my portfolio, and I wasn't just going to cut it because 2024 may be, an underperforming year. But those are the type of things we can do based on each individual company. Now, when you look at the broad market overall, it's really hard to know for sure. And so usually what I tell people when they ask me is that if you really want to ensure success when it comes to investing, the first step is to come up with a plan to where you're consistently investing. And usually that means index funds because it comes right out of your paycheck. It's usually in a 401k, and that's totally fine. It makes perfect sense. If you want to do individual stocks, that's great too. You don't have to. But the idea here is that you're never going to be able to predict exactly what's going to happen either up or down. Now, if you're looking at individual stocks, you're doing that deep analysis and you want to kind of, have an idea of, I think this is undervalued, I'm going to buy it and it's going to go up over time. That's great. You can do that. You can monitor your progress. You can see if it turns out the way that you expected. Sometimes it will and sometimes it won't. So I think out of the 4 myths we're going to talk about today, this one's probably the most straightforward. Like, I think we all agree that whenever someone says, don't invest, the market's going to crash, or hurry up, invest, it's going to go up, I think we all kind of know that nobody really knows. And as long as you kind of keep that mindset and you have a plan to invest that isn't dependent on knowing exactly what the market's going to do, that's really the way to see long-term success, at least in my opinion. Is it me or is it getting hot in here? I don't know. All right, next up, this one's my favorite one of the 4. Don't buy stocks at all-time highs. Now, I hear people say this all the time. People have told me this in comments in my own videos, especially with the stocks that I've been buying lately. Look at this guy buying all-time highs. What a moron. You guys have seen all these things. And my reaction to this historically has been the same. It's been that great companies are going to frequently trade at all-time highs because great companies frequently are making new all-time highs because they're great companies. And I know I use the same words like 50 times, but the point that I'm trying to make here is that we always get focused on what price we paid for something, right? Did we get a good deal? Because if we got a good deal, we feel good about ourselves. If we see a stock where we happen to buy it at the bottom, like we feel like we did something amazing, right? And I talked about that a little bit in a recent video where if you really run the numbers and run the math, if you have any kind of long-term time horizon, whether you get a good discount when you initially buy is really not the most important thing. The most important thing when you buy a stock, if you have a long-term time horizon, is getting a company that is going to be one of the best compounding companies as opposed to buying any company at the best price. And I think this is something that I don't want to say it's counterintuitive, but I think we focus so much on, did I get a good price today? Because that makes me feel good. I can brag to all my friends at what entry price I got on a stock. The reality is, the most important thing is to get the best companies. And buying the best companies at almost any price is going to be better than buying a okay company at an amazing price. It's just the reality of numbers and compounding over time. But when I was preparing for this video, I actually decided to look this up a little bit more than just my own kind of anecdotal evidence. And what I found was this interesting chart. That's the average cumulative returns of the S&P 500 index from a range of 1990 to today that shows the different returns at different time horizons based on when you bought. And it basically compared the returns at 1 year, 3 year, and 5 year for any investment in the S&P 500 that was one of these three criteria, either investing at initial 10% drop from an all-time high, so you waited for the 10% dip and then you bought, or investing at all-time highs, or investing at any time. And what you can see, a little surprisingly, is that investing at all-time highs was actually the best performing time to invest. And that's on each of the three time frames, with the second best time being basically any time. And then the worst performing time to buy was actually on the 10% drop. And the crazy part is that it wasn't just worse by a little bit, like it was significantly worse than buying at all-time highs or basically any time. And I thought that was really telling because I think we've all kind of grown up with this wisdom of, buy the dip and don't buy the all-time high. You're paying too much and all this nonsense, when the numbers don't really say that. And the reality is that if you're buying really great companies, they are going to trade at an all-time high quite frequently. And the other part of this to me is something I've been talking about quite a lot recently, is that the problem with saying, you're buying at all-time highs is that you're only talking about price. You're not actually talking about value. And I think Amazon has been kind of my poster child of this for 2024 because I bought Amazon in January. They've continued to go up and their price to operational cash flow continues to go down because their business is outpacing their stock price. Nvidia is another one, which is doing the same thing. Everyone's talking about how it's a bubble and oh my God, it's so overvalued. But the price metrics are coming down every quarter as opposed to going up. So the cool part about this one is that the next time someone comes to you and says, oh my God, don't buy at all-time highs, you can come back with, actually, that's the best time to buy. All right, so the last one, I'm just kind of calling it Warren Buffett said or Peter Lynch said. And the idea here is that we all enjoy learning from great investors. At least I know I do. I mean, I have tons of books at my house from everyone from Buffett to Peter Lynch. Peter Lynch is my favorite, to, F Wall Street's a great book. I have countless books that I've read about investing and about investors because I'm interested in the topic. I want to know what they've done to be successful. And just in general, I enjoy reading about how other people became successful. It's interesting to me. But the challenge with this is that we tend to take these quotes and these ideas and just blindly copy and paste them into every situation as if they match and are, relevant to every situation. So take, Warren Buffett, be fearful when others are greedy and greedy when others are fearful. And people just blast this out anytime a crappy company goes down 50% and they're like, yeah, I'm going to buy, right? Okay. Or I saw one online where somebody was talking about, the reason why they didn't invest in Nvidia is because Peter Lynch says to avoid hot companies in hot industries, right? And okay, but, Peter Lynch also talks about, companies that have no debt, that have good growth prospects are attractive companies, right? And Nvidia is definitely that. So we can't take these things and just blindly apply them to everything. And that's why I find it funny whenever we kind of argue about, hey, this is the right way or that's the right way. There is no right way. There's only the right way for you. And that's the point that I try to get across on my channel and in my videos the most is, look, I'm not telling you to invest like me. I'm not telling you to invest in the same companies as me. I'm not saying that this is the right way to invest. All I'm saying is, here's my analysis. Here's my strategy, my goals, and here's my transparent results that you get to follow along with. You don't have to agree. You don't have to think it's even good, but it's all out there so that people can see, look, here's why I'm picking this stock. Here's the analysis I did. Here's how it aligns with my actual strategy. And here's what happened, right? And even as I change, like I've made a bunch of changes at the beginning of this year to my portfolio, and everyone's had a lot of comments about it. But that is part of the process, right? Because as humans, other people are going to go through the same thing. They're going to be like, oh man, I did all this. I bought all these companies last year because I listened to everybody talking about a recession and now I regret it. What should I do? Should I just, keep holding because time in the market's better than timing the market? Or do you actually do something about it because it doesn't actually fit your personal strategy? So, it's one of those things where we have to have a nice balance between understanding that we can learn from people who have come before us and who have achieved great levels of success. But at the end of the day, you still have to do it in your way. Like you can't be Warren Buffett or Peter Lynch, or quite frankly, even the stuff that they say only applies in certain points of time. It doesn't apply I can't talk anymore. It doesn't apply blindly to every situation that even they've been in. I look at it like this. We should never blindly follow what anyone is doing ever. The reality is that at some point, we have got to get the confidence in what we're doing, or at least enough confidence to get started so that we continue learning, so that we pave our own way. And then anytime that we see be greedy when others are fearful and fearful when others are greedy, or, we see some YouTube video hype up some crap stock, or even when you're watching my video and I'm going through my analysis, it's not there for you to be like, oh, I agree 100%. It's just another piece of information for you to kind of consume and absorb, and then you to make your own decision as to what makes sense for you. Like that is the only way that this works for any of us, especially if you're picking individual stocks. Now, if you're doing indexes, it's a little bit easier, right? It's at the end of the day, you just believe the market's going to continue to go up. You may have some slight allocation adjustments to say, I want a little bit more tech, I want a little bit more growth, I want a little bit more dividends, and all that is great. That's, again, why they're so effective for most people. But if you're investing in individual stocks, you can't take any of these kind of known investing platitudes or these known investing myths and just blindly apply them. They just don't work. Investing is just one of those things where we're not really competing against each other, right? My returns versus your returns and all that type of stuff doesn't matter. All that matters is, are you making progress towards your goal of building wealth for your family? And are you doing it in the way that fits kind of your perspective, your temperament, and what you're trying to accomplish? And if you are, then you're being successful, right? It doesn't matter what someone else is earning or not earning or what they're doing. And that to me is the beauty of it, right? It's about financial independence for you. So there's no way that we can just copy and paste the same thing across everyone and say this is the best way. It just makes no sense. So overall, these are the 4 myths that I wanted to talk about today. And let me know if any of these are ones that you actually agree with down in the comments below. Now, not only are these misleading in my opinion, but they make us focus on the wrong things. Now, if you want to see what I think is the most important thing for us to focus on as investors, you can click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you all in the next one. Peace.